in Thank you. Yeah, and we are having live interpretation in English and Spanish. The whole webinar is going to be recorded and shared later on our YouTube channel. Hola compas, muchas gracias por unirse a la conversación el día de hoy. Tenemos interpretación en vivo en español e inglés. La primera parte de esta conversación será en inglés, entonces si prefieren escucharla en español, no olviden activar la interpretación. Y bueno, el conversatorio será posteriormente grabado y compartido en YouTube. Agradeceríamos también que no usemos herramientas de IA, de inteligencia artificial, por favor, que creo que vi en el chat que estaban utilizando. Please, if you could not avoid using AI tools for this meeting, that would be great. And yeah, and the recording just started. So, yeah, welcome to today's discussion. I'm saying discussion as this won't be the usual webinar format, but we will rather encourage active participation, questions, comments, and ideas coming from you. Amid this year where we are witnessing imperialist, fascist, and neocolonial attacks on the sovereignty of peoples and territories around the world, from that climate, we think it's super necessary to have this conversation of how imperialism develops in the financial sphere. But let's have this conversation not just for the knowledge to stay in our brains, but to turn this into actual political organization and mobilization. And for those who are not familiar with that for climate, we are a global grassroots movement of movements, and our objective is the unconditional cancellation of illegitimate global south debts to enable a self-determined just transition. We believe debt is the most powerful common denominator behind which our struggles can unite and fight for global social, economic, ecological, and climate justice. And this is why discussing financial imperialism is key for our political education efforts to organize. And now we will start with introducing our amazing speaker, Dr. Bhumika Muchhala, a great comrade and friend of our movement. Bhumika Muchhala is a critical feminist political economist and theorist whose work spans advocacy, research, and movement building in the fields of international financial architecture, feminist economics, and decolonial futures. She serves as a senior advisor with the Third World Network and as a lecturer in the environmental policy and sustainability management program at the New School. Her teaching portfolio includes research as accompaniment, scholar activist methodologies, critical political economy and ecology, from extraction accumulation to regeneration reparation, and global environmental policy and politics. Her transdisciplinary scholarship integrates international political economy, feminist theory, political ecology, and critical traditions within dependency theory, world systems analysis, anti-colonial thought, and decoloniality. Dr. Muchala's research examines economic and financial subordination through the political economy of sovereign debt, austerity, and financialization in the global south. She interrogates the complex dynamics of neoliberal capitalism in the current era through intersectional analysis of dependency, decolonial, and social reproduction theories. Her work seeks to reveal prevailing logics and trace the historical genealogy of structural, gendered, and epistemic power in order to unsettle the foundations of global inequality. In her research methodology, she engages with communities across the global south, experiencing and resisting economic austerity and financialization by formulating social democratic alternatives across policy and politics. So, Bhumika, thanks a lot for being with us today. Let's start with your presentation on financial imperialism, and I'll share your presentation. Give me just a second. Okay, give me just a second.
Yeah.
I think, is it in full screen now? I guess.
Yes, I can see it well. I can see it well. Thank you very much.
Thank you, Bhumika. Please go ahead. Maybe let's aim for like almost like half of the meeting, like 45 minutes-ish, for the presentation, more or less. And then because we
Sure.
don't want interaction, Q&A and comments,
Yes.
and yeah, so
Can
yeah,
can
that's it.
everyone hear me? Can everyone hear me?
Yes.
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 Yes, we
Yep.
can.
Ali, thank you so much for the very generous introduction. I really appreciate it. Thank you for organizing and coordinating us. Um, she put a lot of background work into making this happen. I really appreciate it. And as well as previous workshops on the new international economic order, on economic colonialism during the financing for development negotiations when we were all dealing with policymakers and the very, very low-hanging fruits of policy advocacy. And the Debt for Climate had a space where they were able to really cultivate and nurture a space for deeply critical interrogation and thinking and exploration and discussion. It was a breath of fresh air. So all these events that Debt for Climate does, and the way you're bringing people together, the way you're creating spaces for really critical and multi-dimensional intersectional analysis that employs the deep knowledge that exists in the theory world, in the analysis world. It's not to be taken for granted. I think what Debt for Climate is doing is absolutely transgressive and generative, especially in this time when globally we are seeing a movement toward de-intellectualization. We are seeing an attack on higher education, attack on critical theory, and an abandoning of support and spaces that nurture and nourish this sort of structural analysis. And increasingly in the policy world, we see how the thinking is depoliticized, ahistoricized, and oftentimes turned into technocratic formulations of mobilizing financial resources rather than at all acknowledging that the very structures the world economy is within is rooted in continual and automatic extraction, accumulation, and subordination. So this is the most critical time, I think, right now, where not only do we see an empire hegemon really increasing its imperial drive and strategies quite aggressively, but we see also that other places around the world are in sort of a state of mimicry where they're following, and it has opened the door for even more aggressions. So this is a time where it's more important than ever to really revisit and unpack the dimensions of financial imperialism in particular. So I start with this quote that you may have already heard that is more relevant today than ever. It really is something we need to hear because it also carries so much hope. And it's a quote by Ursula Le Guin, and she says, "We live in capitalism. Its power seems inescapable. So did the divine right of kings. Any human power can be resisted and changed by human beings." So I follow this quote by putting out that to resist and change, we also need to deeply um, comprehend how what we are trying to change, how it is working, because how it is working is not going to be apparent from policy documents or the news reporting or the financial reports or the Ministry of Finance statistics or even many of the kinds of narratives we see. How it actually works is quite hidden. It's never quite in the open where it's visible. So financial imperialism is not new, and it is certainly not immediately visible in the ways that it functions. The classical theories of imperialism highlighted that the largesse of finance and international loan and bond contracts is at the heart of the way finance works as a strategy and mechanism of power. So there was a liberal theorist, J.A. Hobson, in the early 1900s. So this is the really early 20th century. And he put the term the economic taproot. And oftentimes this is referred to for the power of finance. In that the economic taproot behind territorial expansion and colonial conflict and competition was indeed the power of finance. So in 1902, Hobson identified private financiers as the governors of the engine of imperialism. And he really specified banking, brokerage, bill discounting, loan floating, company promoting. Back then, 1900s, 1902, there were not investment banks of the sort there are today, of hedge funds and asset managers. So you see the description, and he calls this the central ganglion of international capitalism. Then there was the economist Hilferding, and he stressed that finance capital seeks not freedom, but domination. And this is achieved through the concentration and centralization of financial capital. Maybe all of you have heard a bit about Rosa Luxemburg. And so Rosa Luxemburg argued very articulately that foreign lending is the, quote, surest tie by which the old capitalist states maintain their influence, exercise financial control, and exert pressure on the customs, foreign, and commercial policy of the young capitalist states. So this is Luxembourg in 1921. And by young capitalist states, she's really talking about within the European American. She's talking about within the metropole. She's not even talking about the colonies. So she's really highlighting the role of the British Empire and the United Kingdom at this point. Let's fast forward to the 1970s. And by that time, in the post-colonial era, at least the post-political decolonization era, the merging of the five biggest global banks has generated a vast concentration. In 1970, the aggregate wealth of the five biggest global banks comprised 17% of total bank assets worldwide. By 2020, just the five biggest banks
Bhumika?
controlled. Yes, yes.
Yeah, sorry for interrupting. I don't know if
Oh,
you
yeah.
could maybe change your microphones to the, yeah, sorry. Instead of earpods, your audio of the
Oh,
laptop.
yeah,
It will be better
yeah.
for interpreters.
Okay. Thank you. Thank you so much. Okay. No worries. No worries. Is this better?
Is it better? Dianex?
Is this a little bit better?
¿Es mejor para las intérpretes? ¿Lo escuchan mejor?
Perfect.
Dice la intérprete que está perfecto.
Oh,
Yeah,
yeah?
it's good.
Okay, fantastic. Okay.
Yes.
All right, great.
But and also, are we on the slide of a very brief introduction, or should I pass to the next
You
one?
can go to the second one. Yes, thank you. Thank you so much. Yes.
Yeah.
Yes, that's great. Yes, I think I was just trying to point out the concentration of credit markets that just in about 45 years, the banking sector really became very small. You had in the 1980s, just in the United States, there were almost 15,000 banks. But by 2009, during the global financial crisis, there were only about 7,000 banks. So within the span of just 30 years, yes, it's exactly 30 years, the number of banks was sliced in half, the number of banks. So this really points to the very aggressive consolidation. You've heard of course, mergers and acquisitions, and this consolidation of power, this consolidation of the institutions is really key to finance. It is always trying to consolidate and accumulate power by forming enormous networks. In fact, all other sectors have a lot to learn about the power of forming network bonds. So I want to really briefly ground our discussion in late capitalism. And it was mentioned by Alicia in the introduction. How do we understand late capitalism? Well, we understand it by first acknowledging that the critique of capitalism in Marxist international political economy, including dependency theories from the South, is very coherently rooted in unpacking the dynamics of capital accumulation, exploitation, crisis, and in fact, the analysis of crisis being that the very dynamic of capitalism is strengthened by crises. Every financial crisis, every climate crisis has a way in which to reinvent the capitalist methods. So crises is inherent to capitalism. There's an inherent natural contradiction of producing crises. That's what capital does, and it doesn't necessarily set it back. If we look at the global financial crisis, we see how the financial sector was very much strengthened by the quantitative easing that followed it, which was like a gold rush of funds that the Wall Street used to invest in global South nations. That was the precedent to the current debt crisis today. And we see how the climate crisis as well has led to such a vast range of instruments in finance. And so crisis is central to the global expansion of the capitalist mode of production. And this is a shift in the way that we in activism and advocacy think about crises as something that is such a dysfunction, that is such a tragedy, which of course in human and social and ecological and moral terms is an absolute tragedy. But in the dynamics of capitalism, it is built in. Crisis is built in, as well as the expansion of capitalism through crises is built in. Without crisis, there is no expansion. So taking this analysis to the post-1970s era, and of course we keep coming back to 1970 as the marker, and of course, as you all know, this is because of the Reagan-Thatcher neoliberal turn in the 1970s of deregulation, liberalization, and privatization. And this was a market turn that something really shifted after the neoliberal term, which was then categorized as late stage capitalism or late capitalism. And late stage capitalism then refers to all the aspects that we resist and campaign on. Neoliberal restructuring, structural adjustment programs, transnational production networks, the global value chains, the ecological collapse, the erosion of democratic sovereignty, financialization. So all the things that we're really seeing at its height today, it's really at its most fleshed out our articulation today, all of these aspects now exacerbated by artificial intelligence, the climate collapse, and the rise of tech oligopolies that, unlike the previous avatar of corporations, the tech oligarchy really is an oligopoly and has no shame in supporting authoritarian and neo-fascist political regimes. So what I want to specify within late stage capitalism is that there are many strands. There are incredible theorists and thinkers that have articulated this. David Harvey and the theory of accumulation by dispossession. Nancy Fraser and her articulation and theory of cannibal capitalism, that capitalism tends to eat its own tail, that it eats itself in the way that it eats the world. There's William Streeck, who talks about financial markets discipline national governments and erode democratic sovereignty. And I have worked with this theory in the sense of how credit rating agencies actually shape and govern economic policies in the global south far more than we think they do. And in fact, we need to question whether nation states have much control and governance power and sovereignty over their national policy making. So what out of all of these theorists, the way that we would ground our discussion is through the ideas put forward by Prabhat and Utsa Patnaik. Prabhat and Utsa Patnaik are South Asian scholars who have long worked on imperialism and unequal exchange. And what they advance is a powerful reformulation of the classical imperialism theory. So they draw on the earlier legends such as Lenin and Luxembourg, but they argue that contemporary globalization and financialization reproduces colonial patterns of surplus extraction through multidimensional forms of drain. And in fact, the multidimensional forms of drain is what many of us work on, whether it's the tax evasion and the financial drain caused by that, whether it's the exorbitant interest rates on debt servicing and the drain of financial resources from south to north caused by that. But what they extend is that it's not just the flow of financial resources from the south to the north, it's also the commodity and resource appropriation, which is facilitated through depressed primary commodity prices. This is the essence of unequal economic exchange. And in addition to the financial resources, it is the monetary and trade hierarchies that underpin this outflow of financial resources. And very importantly, they highlight labor. Labor is often something we do not highlight in our policy activism, but they highlight the reserve army of labor across the global south, and they trace this to the cheap labor available in the global south was produced by colonial history and maintained by the currency hierarchy. Currency hierarchy is what maintains the cost of labor being so cheap. So what we all hear about in such common ways, that companies move to global South nations because of cheap labor. Well, the cheap labor is very much part of the very structure and pattern of surplus extraction. So they challenge what we all maybe intuitively have felt, that formal decolonization has not ended imperial extraction. I have written in my previous work, although anti-colonial freedom struggles had achieved political independence for new nations, there was a palpable sense, most articulated by Kwame Nkrumah of Ghana, that their de jure political colonization ended only to be replaced by a de facto economic colonization. As you may know, Nkrumah calls this neocolonialism. And Nkrumah as well had put forward in a manifesto, in fact, a short book titled Neocolonialism, that looked at the details of the drain from the south to the north, highlighting how this drain requires a management of demand, creating demand and creating structural dependence on the labor, land, values, commodities, and finances of the global south. Right. So I think this was necessary to ground us. What are we talking about? What era? What kind of concept? What kind of formulation? And there is incredible literature on this that there's no time to really go into, but I really would support and uplift the writings of the the Patnaiks, as well as William Streak, as well as Nancy Fraser and David Harvey on late stage capitalism. It really helps us to understand what era we're in, how things are working. So I am going to really focus on the international monetary system and the currency hierarchy and US dollar hegemony, because that helps us understand a lot of what is happening today with this enormous anxiety to maintain the US dollar hegemony, the threat of de-dollarization, and the necessity of the currency hierarchy to remain intact for the next era of accumulation through artificial intelligence and the new forms of tech, especially with regard to the climate collapse. So I guess I would begin by reframing that what we looked at with late stage capitalism in the form of financial imperialism, we can understand it through the framework of international financial subordination. So now we're going a little bit more specific. We're looking specifically at money. We're looking at the politics of money. And international financial subordination explains forms of domination, inferiority, and subjugation expressed in and through money and finance, with effects of penalizing developing nations proportionately. So we are talking about the free movement of capital, especially portfolio capital. We're talking about the hierarchy of interest rates, the hierarchy of currencies, and the kind of management of debt, requiring austerity to be the means of repayment, or completely blocking the creation of a sovereign debt restructuring mechanism. So this is financial subordination. It facilitates that drain, the geographical transfer of finances from south to north. And what it implicates is that political and institutional organizations are fully complicit in maintaining the subordinate position of global south nations in the monetary and financial system. So once we understand that the political and institutions are, they are created to facilitate this, then we cannot say that the multilateral financial institutions such as the World Bank and the International Monetary Fund and the Bank for International Settlements, we cannot even say that they're dysfunctional, because they're absolutely functional and performing exactly what they were created to do, right? So what are they doing? Open exchange, the Maastricht Treaty of the European Union of 1991, all sorts of deregulations and tax environment and labor, the vulnerability of the interest rates and the money and the capital of Global South to international interest rates, to international flows of finances. So what is evident is that that at various levels of economic power internalize the steep costs associated with obtaining and maintaining world market confidence. World market confidence meaning to attract investors and creditors, to maintain financial legitimacy, fiscal legitimacy, to maintain good standing in the gaze of the investors. In post-colonial theory, we often talk about the colonial gaze, and then in race theory, there's the white gaze. When financial subordination, there's the investor gaze. So what that produces is this, regime of investability. How investable is your nation, right? That is often what governs the policy making and the priorities of national governments, much more so than the social contract to provide to the people. So that's, I think, a framework. I'm offering frameworks by which we can understand, right? Because oftentimes in campaigning, we are looking at specific incidents of wrongdoing, and oftentimes we don't pay enough attention to the overarching framework within which all of the all of the wrongdoing is ensconced in. So we have the international currency hierarchy. And what we can understand this is the degree to which a national currency is used internationally to fulfill three essential functions of money: unit of account, medium of payment, and store of value. So the international currency hierarchy may seem just like a natural thing, but actually it's based on these particular. So for example, the Chinese yuan, as it became as it increased its medium of payment, it increased its position in the currency hierarchy over the last 30 years. So in general, currencies of former colonizers and high income countries today dominate these international functions, while almost all global south countries, except for China, have what is called soft currencies that cannot act as international money. So you have this hierarchy or this binary of hard currencies, soft currencies. At the apex is the US dollar. It was adopted as the official global reserve currency in the Bretton Woods Agreement of 1944. And even as of 2022, the dollar is used in 60% of the world's bank loans and deposits, accounts for almost 70% of the global debt issued in foreign currencies, and is involved in 90% of all global foreign exchange transactions, particularly speculative trading. Now, we know today there's a movement of de-dollarization. There's also global South payment systems, in particular the Chinese international payment system. Many other types of payment systems are being developed. What is key to remember here is that the de-dollarization movement we are seeing now, particularly through the lever of China's retail investors and central bank purchasing gold and influencing the price of gold to appreciate by multiple exponential levels, it is not new. In fact, we forget that in the 1980s, in the 1970s and 80s, there was also a movement towards de-dollarization, and it was the 1990s dot-com, boom, and the 1990s era of specific free trade agreements such as NAFTA, etc., that really propelled a re-dollarization. So one thing to be aware of is that even the modern economic history has had episodes of de-dollarization and re-dollarization. Today, we are in a moment of de-dollarization, which is unique because it is being coordinated by many different places around the world. However, we also know that attempts to de-dollarize have been absolutely punished in the past. There has almost, we can trace all sorts of coups d'etats and wars and invasions to efforts to de-dollarize. There are countless examples from Iraq to Libya and most recently Venezuela. So we see how important dollar hegemony truly is. And we trace it to when this new international monetary system was created by delinking the dollar from the gold in 1971. This really propelled the power of the US dollar, right? And this created that rupture in the stability of currency values because governments lost autonomy over their supply of money when free-floating market-based currencies became the norm. Because what that did, what the free-floating market-based currencies, rather than fixed currencies, this liberalization of exchange rates created an increasing dependence on finance to keep growth rates at adequate levels. It really required inflows of finance. So, delinking from the gold standard empowered the United States to become the only country with the ability to print dollars. It requires central banks globally to redeem their national currency for US dollars. So, this is dollar hegemony, the exorbitant privilege. If the dollar experiences volatility in its value, so will other currencies. This unparalleled global monetary power, this privilege, how does it express itself? Well, the ability to print currency to finance its domestic spending, particularly its military industrial complex, the ability to run the world's largest debt at over 3 trillion in value amount without facing the consequences of a currency and economic crisis, all the while imposing unilateral sanctions on other sovereigns, freezing foreign assets, freezing foreign exchange reserve assets, and so on and so forth. So this is really the dollar hegemony. The power of empire is in the power of the dollar. And what makes this monetary system systemic? So I just want to highlight a couple of things that makes it systemic that really underpins how monetary imperialism works. So when nations borrow in a currency they do not control, they are automatically exposed to devastating exchange rate shocks that result in boom-bust economic crises, particularly currency crisis, and this intensification of debt through the currency, economic contraction through the fact that domestic interest rates have to rise. So we come back to, if money is a fundamental attribute of state sovereignty, but sovereign agency over money is so limited by the currency hierarchy and is so vulnerable to international risks, we then have to question how one can have state sovereignty without money sovereignty. Right? So at the very core, the very foundation of the lack or the deficit of economic and national sovereignty is money sovereignty. And what is important here is that we're not just talking about economic sovereignty, right? We're talking about the agency of a state. We're talking about the very dignity and the very ethos of a state. So we're talking about sovereignty per se. We're talking about sovereignty per se. This is where we start really questioning, how the monetary system maintains the imperial structures, how a little how the processes of decolonization really didn't touch the heart, the nucleus of control and extraction, right? So when we talk about autonomy, we're also talking about how then through the monetary power, international capital also disciplines how a nation can allocate money for social, climate, and economic justice and development and emancipation and resilience, right? So we are really getting into the heart of how there is not the control over the ability to make choices and allocate and distribute is all fundamentally threatened. So the role of monetary policy has reoriented its objective from that of fulfilling the social contract, right? Poverty reduction, livelihoods, public services, to the imperative of preserving the stability and return of capital. And we see this nowhere more than inflation targeting, because the profitability of capital flows requires low inflation environments. It is not necessarily economic development that requires low inflation environments, because the history of economic development shows that public investment in jobs, in wages, in services, in industries, in diversification requires some degree of inflation. It requires some degree of inflation. So this anti-inflation taboo has to be questioned as well, right? So the unequal economic exchange, then we go into price suppression, how the currency hierarchy facilitates price suppression and differential pricing in international trade. So what does this mean? Well, the South must export many more units of embodied labor and resources than it imports in order to achieve a monetary balance of trade. So this creates a constant transfer of huge amounts of labor and land and energy, right? The energy also of the labor and land, going back to these really core foundations of understanding capital accumulation as the social relations between labor and land, right? And the implication of this unequal exchange is that for every unit of import from rich countries, developing countries, the global south, has to export many more units to pay for it. And of course, what they are paying for is finished goods, capital equipment, and what they're exporting is oftentimes primary commodities or raw materials, critical minerals. So, how is this maintained? The ever-present availability of cheap labor, cheap resources. Well, by labor surplus, by unequal currencies, and by the undiversified production structures of national economies, which dependency theory really then explains how the production structures are disarticulated from having linkages and from having dynamism. So maybe you're familiar with the collective article titled Imperialist Appropriation in the World Economy, Drain from the Global South Through Unequal Exchange, 1990 to 2015. So this is just a period of 25 years, right? And a team of authors, they really employed quantitative input-output data to quantify the physical scale of net appropriation from the global south. And their calculation was 10.8 trillion in the span of these 25 years, enough to end extreme poverty 70 times over. In aggregate monetary terms, drain from the south totaled 242 trillion. The South's financial losses due to this unequal exchange outstrip total aid receipts over the period by a factor of 30. So, this unequal exchange is a significant driver of global inequality, ecological breakdown, and unequal development. And I think the key point, really, I think, is that unequal exchange unfolds not in like an episode. It wasn't just like an era of, this is just a quantitative example of 25 years, but it's consistent, it's persistent, it's automatic, it's ever present, it's continuous. And then secondly, it doesn't require explicit coercion. It doesn't require military invasion. Oftentimes it comes with it, but it doesn't require physical violence. It doesn't require annexation. It doesn't require occupation in the physical sense. And this is really the key point where we see that public shock and moral outrage over the decades have been diminished because of the way in which unequal exchange unfolds with an, a false naturalization. It becomes naturalized. It's just the way the global economy is. It's an automatic process, right? So the kind of it's the living in, it's the last thing we notice. It's the last thing we really take account of as a phenomenon because it's constantly happening. It has all happened for at least without the unequal exchange from the colonial era is that it is transnational and cross-border. It is very specifically a transnational cross-border project. Another aspect of monetary policy that is extremely important is exogenous shocks. Exogenous shocks really shows the full face of monetary power. So what do we mean by exogenous shocks? Well, we just experienced one after the COVID era, and it's still lingering. It was the interest rate shock. It's called monetary tightening when the US Federal Reserve increases their interest rate. So in response to inflationary shocks, the supply chain issues from the Ukraine-Russia war, and many other aspects of the post-COVID stimulus, the Federal Reserve of the US raised their interest rates 11 times in just 1 year, actually less than 1 year, January 2022 to the beginning of 2023. The interest rates were raised 11 times, and the immediate effect was a 20% appreciation of the dollar. When the dollar goes up, right, there is an immediate capital outflow. that financial capital goes out of the global south back to the safe haven asset of US Treasury bills. So just in 3 months, March to July 2022, close to 32 billion flowed out of the global south, 32 billion. But that's not even the key aspect. It's in conjoinment with, as this capital flowed out, 90 developing country currencies weakened against the dollar in 2023. And over a third of these countries experienced depreciations by more than 10%. By more than 10% results in a plunge in the real value of wages and income. This is why monetary policy is often also known as a de facto class war, a war against the working class, because the ways in which the currencies of the global south can be so vulnerable to losing value, right? In wages and income, but also the pressure it adds on the national import bills because national imports are paid in reserve currencies. And so the cost of those imports goes up. The revenues from the exports goes down. The value of wages goes down. The cost of goods goes up. And you have a currency crisis. And the currency crisis is not just about currency, it's a misnomer, it's an economic contraction, it's an economic crisis. And this economic crisis is really then cemented. The last lock on it is that developing countries have to raise their own domestic interest rates. They have to mirror the Federal Reserve. And this imperative to mirror or replicate, reproduce the domestic interest rate increase is exactly because of the lack of monetary power. The lack of monetary power is not being able to borrow in one's currency and not being able to set one's own monetary policy or interest rate markers. You cannot control your interest rates. You have to increase it when the Federal Reserve increases it. And what is the imperative? Well, to stop the capital outflows. The main way to stop the capital outflows is increasing the interest rates. So the cost of increasing domestic interest rates, contraction of local investments, right? Employment slows down. Local firms borrow less or don't borrow at all. They maybe freeze hiring or maybe they close down. Wages are reduced. Layoffs. People lose their jobs. A full-blown economic crisis that did occur in so many developing countries after COVID's economic crisis. So this was called by the UN, by UNCTAD specifically, as the greatest synchronization of monetary and economic contraction in recent economic history. And really, we're talking about synchronization as in 90 countries. How vast and how totalizing this was. And this is what the US dollar hegemony is about. And despite de-dollarization, if the Federal Reserve increased their interest rates right now, the same would happen. The same would happen. So this vulnerability to exogenous shocks, this lack of agency and sovereignty, right? And let's highlight, because we're interested in debt for climate. So let's highlight debt. Well, the increases, the cost of servicing debt goes up because the amount of payment for the interest payments goes up because the value of the dollar has gone up, the value of the euro has gone up, right? The import payments have gone up. And meanwhile, the economic contractions means that you have higher risk premiums or higher borrowing costs. Credit rating agencies have higher, borrowing cost of capital, or the interest rate assigned to the sovereign bond spreads. The price of your issuing sovereign bonds will increase. As well as the price of credit default swaps, which is an instrument to shield or protect sovereign debts from default. All of these premiums go up. So you got layer after layer after layer after layer of economic contractions, right? And what is the foundation? The monetary power, right? And we know that the way this impacts gender and race and intersectional inequalities is at the very root of it. In fact, feminist economists, they argue that women's labor market exploitation also ensures lower inflation by way of lower wages, so that, women's work exploitation is actually a form of inflation targeting. And that's, I think, the structural contributions of social reproductive economy that we need to maybe also consider, right? That precarious and exploitative forms of employment are also part of inflation targeting, is to keep things cheap. So it's not just about the currency hierarchy on this abstract level, it's how economies and jobs and wages are organized at the very local level. So the way in which monetary power and world currency hierarchy is deployed is very much consonant with a kind of articulation of racial capitalism and patriarchal capitalism as well. In the decoloniality literature, Maria Lugones articulates the coloniality of gender, that women are situated at the intersectional inequalities of gender, class, and race, and they become the sites of monetary extraction through wage compression and loss of livelihoods that are carried out by interest rates and inflations. And we need to look at this as women's bodies, well, working class bodies and their labor build and maintain the value of the very monetarism that subjugates them. Yeah, so the monetary power is also very much ensconced in the bodies of humans, and is an expression of a dehumanized control over life and livelihoods. And underpinning all of this, we cannot forget the free flow of capital, right? The free flow of capital. None of this would be possible without free flow of capital. So we know this idea of pro-cyclical capital flows, right? When times are good, there's surges of hot money inflows from the north to global south. When times are bad, then it goes back. This goes back and forward, this pro-cyclical flow of instability and shock. The currency hierarchy would have no power without the free flow of capital. And this explains a taboo against capital controls. The taboo against capital controls is rooted in the need to maintain free exchange rates or convertible currencies. So we really see how monetary power requires its pillars. It requires free flow of capital. It requires, the inability to control the interest rates. So what has this done? This anxiety. Imagine, being in the leadership of a global South nation, and you have a constant anxiety that with any shock, there could be a capital outflow and a currency crisis in your nation. You are so vulnerable. How do you protect yourself? How do you protect yourself? What is the strategy of self-insurance, of creating savings, right? So there has been a massive accumulation of foreign exchange reserves by developing countries at large. Just between 1990 to 2018, that 25 to 30-year time period, foreign exchange reserves went from 5% of GDP to 30% of GDP. That is a skyrocketing amount of money that's being saved and not used. It could be productively used, but it's dormant. It's not being used. And approximately 60% of foreign exchange reserves are held in dollars as of 2019. By today, it's dropped to only about 50% of foreign exchange reserves, but you still have about half of foreign exchange reserves in and increasing, of course, in gold. But the point is that this self-insurance, the self-protection strategy has a lot of costs. It has a lot of costs. There's a lot of cost to it. It's not a systemic or sustainable solution to prevent financial vulnerability. It can't protect you from the threat of IMF austerity conditioned loans. And most of all, it is deflationary. It is deflationary. It is not actually creating production. It's not creating productive use of money, right? It's going into it's going into assets of rich countries. So it creates a perverse reality where developing countries are systematically lending to rich countries. So you already have this drain, and now you have another form of cheap lending to reserve currency holders. So this really builds in a kind of systemic inequity, right? And the deflationary bias is not just the free lending, but it's that all these reserve holdings have a contractionary effect on the world economy. There could be so much more investment and jobs and climate resilience funds and productive linkages if all of this finance is sitting as protection because of the taboo against capital controls and the free flow of capital and the risks of it was actually able to be used. So, of course, underpinning all of this is a lot of neoclassical or orthodox economic rationale. There's a lot of arguments that you will hear in your economics classes and textbooks. One of the key rationalizations is that if you do capital controls, if you control the movement of capital, it will drive up the cost of capital. It'll drive up the borrowing rates, and it will reduce incoming investments. So then it creates this imperative. Well, we don't want higher borrowing rates. We don't want lower investments. So let's keep our capital flows free and open. So this is the rationalization, right? And it is consistent with this hypothesis that capital controls will create market uncertainty. It will create financial inflow contractions. You will have lower investment levels, lower FDI. You will become an economic pariah. So these are the kinds of rationalizations that really prevent, the policy space and the political will to do capital controls. And so this above what I've tried to illustrate, it's really just a kind of introduction to the web of constraints on the policy space and economic sovereignty of the South. And there are so many multiple forms of liberalization that hollow out domestic revenue generation and economic sovereignty, production structure, diversification, and social and public investment for climate resilience and social equality. But the monetary and the financial architecture maintains this. So I had also a quick section on credit rating agencies. And we can turn to credit rating agencies to really point that I'm sure there's some familiarity, of course, with the current debt crisis we're in. We are in a historical debt crisis, and it remains since the post-COVID era, 50-year high, an average of 38% of budget revenue of developing countries go into debt repayments, both domestic and foreign repayments of debt. You have in about 38% of budget revenue, 30% of public spending. So you really have this constraint on the ability to spend on climate resilience, social protection, health, education, gender equality, adaptation and resilience. You just have this massive constraint due to the debt repayments. So the fact that they are taking a proportion of gross national income higher than at any point in the past 3 decades is the key point. And the material calculus of this debt is that every dollar spent on servicing foreign debt is money not available for development needs, right? So you have a drain via debt, and it is enforced by a regime of international crisis management, as well as the regime of credit rating agencies that determine the cost of capital. It is also underpinned by the need to maintain capital market access as determined by private creditors and the power of creditors to block the creation of a sovereign debt restructuring mechanism and to ensure that debt is repaid by fiscal austerity. So, a quick glance at credit rating agencies. You maybe have heard of the term cost of capital. So the cost of capital is the fact that developing countries face, on average, 3 to 5 times higher borrowing costs than rich countries, even when they have faster growth, lower debt, and strong macroeconomic fundamentals, because it's based on the calculation of GDP. That's it. So it's not based on the health of the economy, it's based on GDP. And you see this really that 74.6% of developed countries have investment grade credit rating, but only 9.2% of developing countries have investment grade credit rating. And in fact, in low income countries, zero, not one, zero, zero low income countries have investment grade rating. So we need to look at how the ratings methodology is biased. Well, the empirical analysis shows that it's mostly GDP per capita that determines the scoring methodologies and population. So even though India has a lower GDP than many rich countries, it has a big population, so that pumps up its scoring. Um, and you have a penalization of low-income countries regardless of their potential or their investment quality, right? So a small country with $10,000 per capita does not have any practical chance of receiving an investment grade credit rating. And this is irrespective of its quality of governance or expected returns on public investments, right? So some of the methodological bias we can point to is that credit rating agencies, they endorse an austerity bias. If you have fiscal discipline, you're credit positive. If you do public spending, you're credit negative. So in the literature, this is called a downgrade austerity vicious circle that credit rating agencies enact. Then we have many other numerous methodological biases, right? One is that the credit rating system is quite punitive. It gives the lowest ratings to the countries with the highest growth potential, and it ignores the long-term structural determinants of debt sustainability. It has an oligopoly formation of just 3 agencies that control more than 94% of outstanding credit ratings: Moody's, Standard, and Poor and Fitch. There is this conflict of interest. It's called the issuer pays model, and the rating agencies are delivering their judgments of the amount of risk X country has, the risk of default, and what its borrowing cost should be, to the very financial clients, say Goldman Sachs or JP Morgan, who pay them for their assessments. So it raises questions. If you're being paid for this assessment by the financial sector, what's the objectivity? What are the motives? What's the legitimacy of your methodology and of your issuance? So this composition of sovereign credit risk is then embedded within, funded by, and accountable to markets. And so it's no surprise that rating agencies have to promote the policies that maximize client profits and market share. That's who they work for. So the absence of impartiality, the absence of objectivity and fairness in the process of the CRA methods have been the criticism that they are undemocratic by nature and they wield enormous influence. They create a supranational and unaccountable governance mechanism, that of markets ruling states, right? So you've heard of this idea, right? That markets discipline states, that market power over the sovereign. You really see it through the rating agencies. But most of all, the thing to highlight about rating agencies is that they punish shocks and crisis, and they make debt sustainability even harder. When countries try to seek out debt sustainability, they get penalized with a lower um, uh, uh, rating or downgrade rating, the threat of a downgrade, higher borrowing costs. If there is a climate disaster, when there's climate vulnerability because of the way they have created their climate, um, they call it the climate credit score. they punish climate vulnerability. If we do public spending because you're recovering from COVID or you want to create more social spending, you are threatened by a downgrade in your credit rating. So this is perhaps best summarized by a politics of penalization. You lock in you lock in these vicious cycles of debt distress, lack of fiscal space, the inability to pursue development pathways, and the inability to get out of shocks and crises by the politics of penalization. So, of course, uh, it is the progressive policies are well known. We need to do capital controls. We need to spend for public and social investment. We need to invest in climate resilience. But what are the repercussions? What are the repercussions? And what do the repercussions mean when the cost of capital goes up, meaning the amount of money you have to pay for issuing your sovereign bonds, the rate of return that is attached to sovereign bonds issuances. Almost all countries and businesses raise money by issuing bonds, but if the rate of if the rate of payment attached to your bonds issuance becomes higher and higher, that is a massive punishment. That is more and more payment to creditors. So your ability to access money from the credit markets becomes very expensive, right? It's literally like raising the cost of the yeah the cost of living for the nation as a whole. So, rating agencies are really coming under scrutiny today. There are many recommendations we have forward for not just reforming credit rating agencies, because there is a lot of doubt, maybe if that could be done, but by establishing a multilateral credit rating agencies within the United Nations. The African Union is pursuing an African credit rating agency. So these momentums have been starting as a response to rating agencies. And last but not least, to conclude with just that the struggle to call for the struggle to to demand a sovereign debt restructuring mechanism goes, and it has been consistently blocked, consistently denied. And this consistent denial has to be seen not just as a political kind of problem, but as a strategy to maintain debt colonialism, right? I mean, economic law scholars have always said that international bankruptcy rules for sovereigns, for countries, are the unicorn that we have all been chasing since the 1930s. That just as you have international bankruptcy codes for firms, even for individuals can file bankruptcy, but a nation cannot seek a legislative process to repair their bankruptcy or repair their insolvency. And so this political refusal goes back to Henry Kissinger in 1974 signing cables saying that the US cannot participate in any restructuring of developing country debt. This was a red line for the US, which remains today. And really, we need to see this as not just a key method of development of underdevelopment and unequal exchange, but a key method of ensuring that austerity is a norm, that austerity policies are a sort of economic naturalization in the global south. Because as long as there's no ability to reschedule and resolve debt through proper haircuts, through equitable, uh, relief and burden sharing, because the private creditors, which have increased by 5 times since the global financial crisis, private creditors are getting enormous interest rates, as we see through the credit rating agencies and the cost of capital. They're getting enormous interest rates. So they have to be held accountable to restructure and to take the risk of default, right? But the fact that private creditors have really made it contingent, repayment contingent on austerity, public sector wage cuts, expenditure reductions, privatization, labor market flexibilization, inflation targeting, natural resource extraction, trade liberalization, central bank independence, all of these austerity measures is really, I think, at the core of maintaining unequal exchange, maintaining the disarticulation of the national economic policies. So I really invite questions and thoughts from all of you. I apologize, this was a little bit longer than I expected. And I am aware that I did go through like recommendations and policy solutions. There's plenty of that available. And I can send many resources on what kinds of reform proposals we are suggesting and that we have been fighting for. But I have a sense many of you know what the ways, what the reform, what the solutions we are asking for. Perhaps the whole point right now is to really understand the political economic dimensions of neocolonialism and imperialism that we are up against, um, and that our struggle must be really our strategies must be quite nuanced to really address not just the technical proposals, but really the political shifts that all of these rationalizations and these methodologies and these processes, these hierarchies must be unsettled, must be unsettled. There's no quick fix. There's no quick policy fix because the structure is so historical and so coherent. So I really invite questions. Thank you so much.
Many, many, many thanks, Bhumika. This was amazing. We have received so many positive feedback from the presentation. We only have 15 minutes, so let's try to make best use of them. Reiterating that we have a Spanish interpretation, so also encouraging our comrades that are Spanish speaking to post your questions in Spanish. So yeah. So yeah, maybe we can do a round of like raising hands if you have some questions and comments. Bearing in mind that we only have 15 minutes, so like to have as much comrades speaking as possible. Also, if you cannot yeah, raise your hand, you can put it in the chat, and if someone could also like help me like telling me about the questions to not miss them. So first we have Julio Linares. Please go ahead.
Hi, Bhumika. Thank you so much for that wonderful presentation. I just wanted to thank you for that. I had a question, which is maybe a bit of a sneaky question because I wanted to ask you. I know you didn't go into policy solutions and stuff, but I'm really curious for you to, based on what you said, expand upon your notion of what dual delinking would mean, thinking about this idea that there is no quick fix and we need to delink following Samira means. So if you could expand a bit of what your concept of dual delinking is. And then for for us, for those of us who are involved in like social movement organizing against debt and for things like economic democracy, you hear a lot about things like BRICS and all these sort of state-driven technocratic solutionism. What's your take on that, and how do you see a strategy moving forward for like from the grassroots? Thank you.
Thank you, Julio. Um, and then we have Justin asking what are the solutions briefly. I don't know if there's any other more questions to just group them and have Umika answering, or we can just go ahead. No, I think we can just go ahead because I think this will be quite a long answer to the question of Julio. Bhumika, please go.
Are you sure there's no other? It would be good to hear other comments or thoughts. I would really invite anyone to speak.
Mhm. Is there anything in the chat I am missing? Maybe I don't know. I'm just going through it.
Sorry, I was trying to raise my hand, but I couldn't, apparently. Yeah, my question is actually very similar to the one already posed, so that's why I was not coming ahead. But I'm very interested in relation to cooperation between global South countries. If without a structural change, then there is not the risk of coming into the same dynamics of currency hierarchy and imposition on one another in this capital system, and what are the solutions and the alternatives that are now from the grassroots movement shaping.
Many thanks. I mean, if I can just add a little bit of like question. Oh, there is a new one. Sarah Wasif, do you see a historical fissure between the flows of finance between lending institutions like the IMF and private finance, or can they be categorized equally? So that's also another question from Sarah. And I just wanted to maybe add like about this the linking perspective. How can we go forward in our organizing based in all the presentation? Just to keep it brief. And yeah, now passing back to you, Bhumika. France.
If it's okay, can I just have you repeat the last question?
Okay.
I think I got all of them, just the last one by our friend who spoke, grassroots organizing. I just couldn't hear, the voice went in and out.
The last one, from Sarah or
Yeah,
mine?
yeah.
From Sarah. Yeah, they say, do you see a historical fissure between the flows of finance between lending institutions like the IMF and private finance, or can they be categorized equally? They put it in the chat.
Okay. Okay. Yes.
And
Yes. Okay, that's
the,
actually a great question. Just to clarify. Yeah.
there's another hand. Maybe we can take
Yeah.
also that one. And Irene, please go ahead.
Yeah, thank you. Sorry, sorry, I was trying to raise my hand. This is a quick one. A friend of
We,
mine,
we cannot hear you well, Irene. The audio is not good.
yes, shall I, maybe I should try to type. Maybe try to type.
No, we cannot hear, but you can write it in the chat maybe.
Yes, I'll do that.
Okay. Maybe Bhumika, you can answer on the meantime, and then I'll read the question posed by our comrade later.
Yes. Was it Irene? Yeah, we could not, for some reason we cannot hear you. It's very muffled. So if you can just write your question, that would be really fantastic because we want to hear your questions. Um I feel enormously bad we don't have more time for discussion and questions and to hear your thoughts as well, because many of you have incredible ideas and experiences. We need to create more forums to keep sharing. Yeah. I think I will just tackle a few of them. I cannot tackle maybe everything in completeness by sure, and I would love your thoughts as well. I really invite Julio as well as others to share your ideas and thoughts. But when it comes to BRICS in particular, there's such a debate and tension around the degree to which they are reproducing the neoliberal mechanisms and dynamics of neocolonialism internally and regionally. So the degree to which, China and other wealthy middle income countries are enacting the same patterns, the same mechanisms. And then there is a really vibrant debate that no, they are doing something different. They are not just enacting the same, they are doing it in a different way. It is more regionally coherent. It doesn't involve a military industrial complex. And let's not forget that the monetary power and US dollar hegemony is maintained also by the military base, the more than 800 military bases around the world. Military power and monetary power are always conjoined. So what BRICS is doing is something a little bit different in that sense. The New Development Bank and its loans do not have the same sort of conditions. They don't necessarily have a developmental priority of social spending and public investment, but they certainly don't have the same kind of um, structural adjustment, to structural adjustment embodiment to their loan policies. So that makes it somewhat different, right? So I think the imperative with, especially with the BRICS de-dollarization and payment systems, is that they are also at the same time as they are seeking ways of de-dollarizing, are also prioritizing diversification and transformation of the production structures. That structural transformation is not left out or diminished in the far more glamorous pursuits of de-dollarization and payment systems, which I'm saying glamorous not as a way to mock, but as a way to distinguish that oftentimes this gets prioritized or highlighted by even those of us in the movement spaces. But we need to always look at it. We need to constantly remember that at the heart of the monetary is the production structure as well, right? The production structure, which determines the labor structure, which determines the um, you know, the theories of labor and value, and how this extraction that the Patnaiks point out about the imperialist appropriation through labor surplus and the artificial depression of commodity prices. So while we talk about de-dollarization and payment systems, we also need to highlight the price stability boards for commodities, commodity regulation boards. We need to highlight remaking or decolonizing the global value chain from the power of the lead firms and the relegation of unequal terms of trade through the plantation economies and cheap commodities, the ability to have backward forward linkages to process and do value added manufacturing. If BRICS pursues these goals in the context of the great mineral grab, there's a great resource grab happening right now. This mineral grab, there's critical minerals, as well as the artificial intelligence enacting a new wave of climate colonialism through its ecological impacts, right? So I think really right now in this current context, we see this enormous resource grab from the minerals, the water, and the artificial intelligence for the just transition and big technology. How does this threaten of very old forms? How does this reproduce? That's the word I was looking for. How does this reproduce such old forms and patterns and mechanisms of imperial extraction? And how can BRICS really counter this? How can BRICS really form, say, producers cartel, mineral producers cartel, mineral producers club, um, real regulations that are not just national, but an international or a kind of code in place on environmental regulations related to AI. Just to highlight the question about the International Monetary Fund, the International Monetary Fund can be seen in many ways as the handmaiden of private finance creditors. They are the protectors of private creditors. They bail out private creditors, and they bail out private creditors by, instead of private creditors having to take a haircut during sovereign debt management, during sovereign debt restructuring, the IMF comes in and says, oh, you have to take out a loan instead of having reduction of your debt. You have to take out a loan. So the IMF can be seen as international debt crisis management or international crisis management. They protect the private creditors from having to have any reduction in their profits or any loss of accumulation through the loan process, right? So the IMF comes in and says, oh, you cannot restructure your debts, but you take out a loan, and this loan will help you pay your debt. So they bail out the private creditors by ensuring that the sovereign borrower then has IMF conditionality laced loans to pay the private creditors. So I would really, really want to enhance the understanding of the International Monetary Fund rather than a multilateral institution, which we all know it is governed by the US Treasury, has a veto power, it's very unequal governance, developing countries don't have a voice, so we have to question how multilateral it is, to understanding the IMF as the facilitator and the guardian of private finance creditors and banks. In dual delinking, I'm going to just paste something I've written on it, and you can just take a look at that instead of me talking anymore. But in short, I very much support Julio's uplifting of dual delinking. It is something that I have put forward as essentially we need to combine Samir Amin's and dependency theories, ideas of delinking in the material, financial, structural with the decolonial theory, the decolonial schools mandate of epistemic delinking from the mental colonization Frantz Fanon always spoke about, from the epistemic imperialism of how we think, of how we know what we know, of how we understand, how we rationalize, and in particular, the decolonization of economics, the revealing of, what logics underpin economic policies. What is the logic of interest rates? What is the logic of inflation? What is the logic of debt sustainability? To really unpack how thin those logics are, to really decolonize. But especially dual delinking, I would just say essentially is that we have it is this world making radical imagination, a radical imaginary of world making that says we need to rethink, we need to reorient from imperial extraction accumulation, from dependency, as well as remake our understanding and our knowledge systems, and that it is this inherently the world is a reflection of our imagination. The world is a reflection of our thoughts, but particularly we are living in the imagination of the white male supremacist power figures of the last 5 centuries. We're living in the neo-colonial imaginary. We're living in the imaginary of a white supremacist patriarchal capitalism. So, in order to remake our material world, how do we exit the imaginary and build our own imaginary, build our own worlds, and not in enclaves, in like, you know, your off the grid rural farm commune, or creating a small group of people who are having a different way of life. That all sounds really amazing, but really to create it in the real world, to really create it in the real world by not simply grassroots resistance and campaigns, but also coming together with a vision, with a radical imaginary, with a radical vision that takes all the existing dependency world systems, Marxist, Keynesian, developmentalist, structuralist, feminist, ecological, decolonial, transnational feminist, takes all of these critical race theory, takes these incredibly rich spaces of knowledge and thinking, and creates a new world, creates a new world. And that, I think, gives me hope, because fighting is very exhausting, and fighting continually, with every crisis. I mean, the world is shaped strategically so that crises keep coming, right? So how do we get out of just whack-a-mole crisis fighting to reimagining and building community. I cannot emphasize that more. Dual delinking is also about rebuilding our social relations because we know that capitalism and imperialism cannot work without the social alienation that it puts us in, the separation. And today, driven by AI and social media and TikTok and everything. So rebuilding our social relations, our connection to each other, right? So I think in short, dual delinking is a vision for hope and justice and um, a life worth living, a world, making us more deserving of planet Earth. I often feel that we don't deserve this Earth, so let's figure out how to deserve it, and rebuild our own humanities. Yeah.
Mm. Oh, many things, Umik. Actually, yeah, I think those words are so on point to like all the moments we were living in, like rethinking a new reality. So much needed. Um, yeah, I know we're like a little bit out of time, but like I think time is not enough for all these discussions. We could continue for ages. I see there were some two pending questions on the chat. But yeah, since we have interpretation, and actually it was until like 4 minutes ago, and also in respect to our comrades that are Spanish speakers, maybe we can wrap up here, and we can, yeah, and Bhumika put her email there, so you can contact for like to continue the conversation. Also, and yeah, basically thanking everyone for being here, the proclaimed members, the friends, the allies, everyone that have joined us. And yeah, let's keep like not keep this in our brains. Let's turn this, all of the presentation of Bhumika, all the reflections on like what can we do to organize in our territories, what can we do to organize with our allies, and yeah, and let's make this a living knowledge. And for the ones that just knew about that proclaimed today, we are a global grassroots movement, and if you want to join us, we have regular onboardings for new members in Spanish and English. My comrades will put the links in the chat and the times where these onboardings will take place or will take place soon if you want to join us and organize together. We also have a reading group in Spanish that you can join. That happens every Saturday. We read authors like David Graeber, for example, and the link will also be on the chat. And also we have, yeah, I mean, to carry out all these political education sessions and organizing protests, etc. Yeah, we need resources, and we are having a crowdfunding campaign that will the link will also be in the chat if you can support us in this regard. And yeah, you can always contact us through info@theproclaimed.org if you have any questions, comments, and yeah, as a follow-up. And just, yeah, you student here. Well, thanks. That's it from my side. And many, many, many thanks for all your contributions, your time, and let's see if we can have a follow up of this conversation, because yeah, we can never end this conversation. And yeah, and Bhumika is sharing her work also on the link. Many thanks also for interpreters for their time, for making this knowledge also available for our Spanish speaking comrades. And I think that's it from me. And yeah, many, many thanks to everyone. Bye. Gracias.